Good morning, and thanks a lot for coming out this morning to listen to me speak. I'm going to save you a lot of time like I did last year. It's going to be a great year. It was a great year last year, and so meeting is adjourned. Thank you very much for coming. It's my pleasure to be up here to welcome each and every one of you to I think it's the 13th Economic Forecast Breakfast, if I'm not mistaken. But I am John Rice, 2014 Chair of the Bradenton Area Economic Development Corporation. And on the behalf of the EDC, we'd like to welcome you to the 2014 Economic Forecast Breakfast. I would like to extend our extreme gratitude to Hancock Bank for its generous sponsorship of this forecast breakfast for the past, actually, 15 years. I'd like to give them a big round of applause. And now join me, please, in welcoming Mac Caraway, my good friend, President of SMR Farms, who will give our invocation.
Good morning. Please join me as we bow our heads. Dear Lord, we thank you for this excellent day and for the people in this room, an incredible assembly of government, business, academic, and community leaders. Please be with us as we listen and learn together. We ask that you bless this community and its businesses with health, perseverance, and prosperity in the coming year. Help us to always remember that with each measure of these blessings, there should be an equal measure of gratitude to you, from whom all good things come. Finally, help us to remember those who struggle and those in need, that we might show the true heart of this community, revealing its belief that generosity is a privilege and not a burden, as the people and businesses of Manatee County have demonstrated so often over the years. We pray these things humbly. Amen.
Thank you, Mac. You know, to give you a little bit of insight on these speeches, you know, for the years that I was and still are involved with the Chamber and the EDC, typically what happens is they give you a script that they want you to say about a week ahead of time, right? So I would get a script, as do anyone that does any of that for either one of the organizations. I'd get a script about a week ahead of time. It'd give me about a week, you know, if I had a little downtime at work, to kind of butcher it up, change it up, put in what I thought would be humorous in these speeches, which many times are not. And so then we would have a lot of fun with it. Well, I got this about 2 o'clock yesterday afternoon, and Sharon finally figured it out. Just don't give him enough time to look at it, and so he'll stay on script. So fortunately for you, I'll be staying on script today, and providing I can read, I'll go right off of these pages. So at this time, I would like to and pleased to recognize our public officials scheduled to join us today. Please hold your applause until after we have recognized each and every one of them. From Manatee County Government, Commissioner Larry Bussell, Commissioner Vanessa Baugh, Commissioner Betsy Benak, Commissioner John Chappie, Commissioner Robin DeSabatino, Commissioner Michael Gallen, Commissioner Carol Whitmore, Manatee County Administrator Ed Hunsaker, from the City of Bradenton, Mayor Wayne Poston, from the City of Palmetto, Mayor Shirley Groover Bryant, Commissioner Brian Williams, and Commissioner Jonathan Davis. From the Town of Longboat Key, Vice Mayor David Brenner and Commissioner Pat Zunes. From Manatee County School Board, Chairwoman Julie Anabar. From Congressman Vern Buchanan's office, Special Assistant Gary Tibbetts. Let's thank all of these public servants for attending today and their continued support of economic development in our community. Through the commitment of public officials, private investors, and a diverse coalition of leadership, the EDC is delivering results for the local community and the economy. I'm excited to share with you that based on activity we've already seen and the pace of our leads, the staff is managing. in the Bradenton area EDC, and the Bradenton area EDC anticipates another strong year in 2014. Just last week, we announced another local expansion and celebrated the dedication of new air products manufacturing facility right next to the port. And many of you, I think, attended that function and came back with really a wow concept of what they're doing out there. That's really going to be awesome. We're also off to a great start and have every reason to expect continued positive results as we aggressively market our new website, cultivate relationships with site selection consultants, and pursue a robust program to assist local businesses that want to grow here. The EDC is often asked, why would a company want to relocate or locate or expand in the Bradenton area? Maybe you have asked the same question. We have answers for you. Take a look at this.
This is big. Deciding where to relocate or expand your company could be one of the most important decisions you ever make. But once we show you all the Bradenton area has to offer, we think your interest will soar. We have an excellent track record for enticing top companies to the region. Industry leaders challenged to meet growing demands. International manufacturers breaking into the U.S. market, all experiencing phenomenal success. And your company can too. Picture this, your business strategically situated on the beautiful and thriving west coast of Florida. You'll be part of a robust 9 million person Tampa Bay market. You'll tap into a diverse labor pool of talented workers, be eligible for training grants and assistance, and enjoy lower labor costs. You'll be within a 2-hour drive of 5 international airports. And Port Manatee, the closest deep water seaport to the Panama Canal, will be right in your backyard. A few other things in your backyard? Miles of beaches, an abundance of sports and recreational activities, a cultural scene that rivals big cities without the urban hassles, and major universities, colleges, medical, and technical schools. Everything families need to build a fantastic quality of life, and I haven't even mentioned the climate. No, not the balmy summers and absolutely gorgeous mild winters, the tax climate. Florida is ranked in the top 5 in the nation for most favorable business climate. And with one of the lowest millage rates in the state, a Bradenton area address could yield a significant tax savings. Need more incentive? You may qualify for a variety of economic development incentives that offer a major cost and time savings for your business. Oh yes, there's a lot to lure you to the west coast of Florida. Join some of the fastest growing businesses in the world that call the Bradenton area home.
So our new motto this year might be, if we're going to do it then, we're going to do it big then. Has anybody ever heard that? Don't we have any Florida State fans in the room? So it's plain to see the Bradenton area has a great story to tell. Many thanks to all of you for supporting the EDC by attending this morning's event. Although we have 2 great events coming up. One is really outstanding. That's going to be the Major League Soccer preseason games being held at the IMG operation January the 29th through February the 12th. And if you've never been there to see the new facilities, the new stadium, and what's going on with the construction and how they're expanding, you have to go to this. And even if you can't go to this, have your company or your business buy a bunch of tickets, because 25% of those proceeds are going to be going to the EDC. And give them to all of your associates, all of your employees, your neighbors, your friends, and so forth, and help IMG put butts in those seats, because we need to show a great deal of support for what they're doing here in Bradenton. Secondly, and last but not least, the best networking event in the region, the Hobnob Barbecue on February the 20th. What do you think about that? It's going to be indoors again. We're not going to be fighting with the weather, and so we're really looking forward to that. And now it's my extreme pleasure to introduce Mike Michella, Manatee Sarasota President of Hancock Bank.
Thank you, John. I first off want to just thank everybody for coming out and supporting this event again this year. For 15 years, we've held the event, and what started out as a small gathering of bank officers and clients has grown into this breakfast where we have over 350, 400 business and community leaders out to hear about the economy. And one thing that we've learned is that we are only as good and as strong as our economy. As a bank, we are a compilation of all of you individuals and businesses. And so if you want to know who your strongest supporters are in the community, you can definitely look at Hancock Bank as one of them, because we want you to do well, and that helps us all do well. I'm always excited to hear what the forecast is. I do also like knowing how we did last year, too. I think, as John mentioned, I think we did well, and I look forward to a good 2014. But Dr. Fishkind always has some good insight and really can help us manage our businesses and grow our businesses and plan for future events. With over 30 years' experience in economic analysis and forecasting, Dr. Fishkind is widely regarded as one of Florida's premier economists and financial advisors. Dr. Fishkind's career began in the public sector, where he worked as an economist and associate professor at the University of Florida. In 1980, Dr. Fishkind became the associate director for programs at the University of Florida Bureau of Economic and Business Research. During his tenure at the university, Dr. Fishkind served from 1979 to 81 on the Governor's Economic Advisory Board, and he went into the private sector as a consultant when he became president of M.G. Lewis Econometrics in Winter Park, Florida. In 1988, Dr. Fishkind formed Fishkind & Associates as a full-service economic and financial consulting firm. And we really appreciate him having the history with us and coming back to Manatee County and really helping us understand what's going on around us so that we can make sound business decisions. Please join me in welcoming Dr. Fishkind back to the Bradenton area.
Well, thank you all very much. It is always a pleasure for me to get to come to visit with you each year. And it's particularly nice when I have something good to say, so that'll be a pleasure. You're going to have to excuse me. I'm going to have to turn just sideways so I can watch the screen a little bit, because I can't point at the slides and tell you what's going on unless I look. So with that, we're going to have slides in a minute, I promise. Even I can't stand an economic lecture without pictures, so we'll get it done. But it's sort of like a biblical kind of presentation. I mean, we've had sort of like Joseph's dream, 7 lean years, and after following 7 fat years, and this is finally going to be the breakout year, both for the United States and for Florida. The basic economic factors are strong, and finally, we're past some of the uncertainty that was put into the economy by the federal government. Like I said, I think this is really going to be a breakout year. You can see that labor markets, notwithstanding the December labor report that we'll talk about, are very strong. We're talking about 200,000 plus jobs each month. Very strong housing markets. What many people ignore is what's happened in our energy markets. The United States is on the verge of becoming a major energy exporter. Energy production has risen in the country so strongly that it's driven down the price, not only of gasoline, but natural gas and electricity, providing a significant competitive advantage to the country. We're past sort of the drama, or some of the drama in Washington. We finally have a 2-year budget for the first time in almost a decade, and it's a big deal. Yesterday, the House passed the omnibus budget bill for this year, and I think it's a precursor to sort of less drama, and as long as Washington can sort of stay out of the headlines, I think the economy will do rather well. Monetary policy continues to be extraordinarily expansive, if a bit less so. I mean, we're into the tapering, but even with that, we still have a tremendous amount of monetary stimulus, extraordinarily low interest rates. So I'm very positive, but there's all kinds of risks to the forecast. I think the biggest risk relates to sort of how does the Fed unwind this stimulus without pushing interest rates too high too fast? Will the federal government and the Congress in particular pass an increase in the debt ceiling with not too much drama and kind of get past all that. We're going to have some blow up in the Middle East or Pakistan or some damn place or another. I mean, all that stuff can happen. But odds on bet, 4% growth, 3 million jobs, a strong national economy. Looking to Florida, there we go. This is a very strong cyclical upswing. I mean, it's not going to quite be the boom of 2005 to 7, thank God, but it's almost as good. We're talking substantial amounts of population growth and employment. If anything else, 350,000 people move into Florida, a significant amount of jobs and housing. So I'm quite optimistic about it. The other thing that's interesting, and you all see it here, and I'll show you some pictures of it. First of all, the west coast of Florida has really recovered finally over this last year. And secondly, the locus of growth within our state has shifted to the I-4 corridor, sort of from Bradenton to Orlando. And so that also benefits. So I'm quite optimistic about where we're going. Let me just start out. And here's gross domestic product in blue, inflation in red. If you look on the right, that's the growth. And you can see each quarter this year, growth has accelerated. 4% in the last quarter, third quarter. Looks like the fourth quarter is going to be 3.5%, 4% growth again. So we're finally getting into the breakout phase where the U.S. economy can have substantial, sustained, strong growth. And that will drive Florida. This is jobs, and this last number doesn't make any sense. I mean, we're banging along at 200,000 jobs. We have strong other data that I'll show you in a minute, and all of a sudden, employment comes in at 74,000. It just is probably going to be revised. It's certainly weather-related. The components that were down significantly were construction, which is obviously weather-related, information, which relates to a number of things that also were weather-related. So I don't think this is a precursor of any particular problem. If we look at the new claims for unemployment compensation, again, you see some, moving, that's not going to show on that screen, sort of, to the right, you see the government shutdown, the big green spike, and then you see the weather-related. And so, again, I don't read much into it, but I do believe this is going to calm down. Now, this indicator, before I leave it, is one of the best leading indicators for the economy. It comes out every Thursday morning at 8:30. Any number below about 350,000, if you listen each week, would be consistent with 3% to 4% growth in GDP. New claims for unemployment compensation, Thursday morning, 8:30. So with that, consumer confidence ramped up significantly, you can see on the right, once we kind of got past the drama. On the, in the middle of the chart, when we were going to have the government shutdown and all the drama, you can see it really hurt consumer confidence. And it really hurt business confidence as well. But now that we're past the drama, this is the highest levels of business confidence this index has ever had in its history. Businesses are extraordinarily confident. They have a lot of capital. And in order to continue to expand output, they're going to have to start hiring. We pushed productivity about as far as we can to meet rising demand. So productivity is not growing as fast, which on the one hand you could say, well, that's not a good thing, but on the other it means there's going to be a lot more employment in order to sustain the gain in top-line demand. And I think that's where we're getting to in this business cycle, and I think that will be very beneficial, in fact. Retail sales on the right, you see significant retail sales in December. The total sales in blue are a little lower than the non-auto, non-gasoline sales, or core sales in red. So core retail sales are rising strongly. This was a good Christmas. Auto sales were a little down in December, but that's only temporary. The average age of a car in this country is 10.2 years old. So we're going to see a lot of cars sold. So I think, if you look at these retail sales data, they don't fit with the employment data. The confidence doesn't fit with the employment data. The employment data is just wrong. So I'm quite confident that we're going into this first quarter of 2014 with a pretty good head of steam, 3.5%, 4% growth in the fourth quarter, strong precursors here. The supply manager index is also pointing up. This is a very sensitive monthly index. You have both manufacturing and services. Any number above 50 is expansionary. What's driving those indexes is new orders. So with new orders rising, driving the indexes higher, what this is saying to us is that purchasing managers are going to be doing a lot more hiring in 2014. And so all of that is sort of part of this self-generating cycle of higher demand, more employment, more income, more demand that gives rise to 4% growth, which is where I think we're going. Home sales have risen significantly, but you see them topping out. Interest rates have risen now sufficiently so that sales are much better than before, but they're not accelerating anymore. If you look on the right, you don't see that acceleration in the sales. So I think over the next year, this illustrates an important sort of theme for 2014. On the one hand, we have growing demand fueled by higher employment and higher income, relatively low inflation, so a good amount of growth in disposable income on the one hand, and then we have rising interest rates on the other. And so there's a tension between the two, and you see it playing out here in housing. But there's a tension between the two. I think in 2014, rising demand and income will outweigh the higher interest rate effect. So we'll grow at 4%. Housing starts will remain high, but probably don't rise much above current levels. They're running pretty strong now. When we get to 2015, it's sort of a standoff between interest rates and growth and income. When we get to 2016, interest rates are going to start to win and the economy will slow down. I think that's the general dynamic. You're seeing the very beginning of it here played out in housing markets, but it will play out in the rest of the economy as 2014 continues into 2015. Trade. Normally I don't show you trade, and it's a little geeky, but you'll bear with me for a minute because it illustrates something important. If you look at the last 3 bars on the right, you see our trade deficit shrinking. It's still negative, but it's less negative. And so that translates into more GDP growth because there's less drag. The main reason that our trade balance has improved so much is from tremendous amount of oil export and less oil import into the country. And so the combination of the two has improved that by $10 billion in 3 months. That's worth a half a percentage point of GDP growth. Half a percentage point. It's significant. And so it illustrates the sort of hidden, if you're not in North Dakota or South Dakota, you don't really get it. The magnitude of the energy boom in this country has changed the pricing structure. And so it is a tremendous benefit to us, not only in terms of GDP, but in terms of our productivity and the price structure, how much people spend for gasoline that they don't have to spend now, they can spend on other stuff. I mean, this energy boom really has made a dramatic difference in the U.S. economy and will continue for another decade at least. So very positive for us in this country. Consumer Price Index, not much to say about it. That's a good thing. There's a lot of concern that this extraordinary monetary policy we've had is going to somehow cause inflation. Well, yeah, over the long term, if monetary policy just would continue to expand at an $85 billion per month pace, yeah, it would cause inflation in the long run, but not in the short run. And there's really no inflation to be worried about. So we have sufficient time for monetary policy to unwind the stimulus without triggering off substantial inflation. And you can see it here. You can also see it in the Producer Price Index. Yeah, there was a little blip up in the last month, but there's very little inflation coming through the system. This was a blip in intermediate goods. Crude prices, commodity prices are still very low. We're running at some of the lowest corn and wheat prices this country's seen in a decade. There's nothing in the metals. Oil prices are low, so there's just no reason to fear in the short run that we'd have any significant amount of inflation, giving the Fed time to unwind, and we'll talk about that in just a second. So, the Fed. The Fed has said that they are going to stop the level of quantitative easing. I'm sure you're shocked. The Fed has said for years, this is a temporary program. So eventually temporary programs come to an end. And that is exactly what happened. Janet Yellen now is the new Fed chair. At the last meeting, the Fed announced that they would begin to reduce the purchases of bonds. So they're going to reduce it from $85 billion combined per month to $75. And then it will go down by $10 billion a month each month until the program unwinds. That's quantitative easing. It has been very effective. It has driven interest rates down. It has stimulated the economy. But the Fed has said something else that sort of got obscured in all the drama about the easing. The Fed continues to say that they will maintain very low interest rates. Translated into English, the federal funds rate will be essentially zero. And they set quantitative targets. They said that until the unemployment rate gets to 6.5% or inflation rises above 2.5%, the Fed funds rate will stay at zero. So we have an unwinding of the quantitative easing, but we have a maintenance of the low interest rates. So it's very important. We will continue to have substantial amount of stimulus, just not as much. And what's interesting, in May, when the Fed first, in May 2013, when the Fed first announced that they were going to begin the tapering, the bond market went berserk. And the 10-year bond rate went up 1 full percentage point or 100 basis points like in a week. And then it slowly came back down a little bit. 10 years of trading still significantly above where they were. The Fed announced in December that it was going to actually do the tapering, and it began to taper, and what did the bond market do? It rallied. Interest rates didn't shoot up because the bond market is becoming accustomed already to the fact that this is going to go away. Now, that's not to say that interest rates aren't going to rise. My point is they're not going to rise at the same rate that they did in May. There'll be a much more slow increase in the 10-year from here going out, I think, as the tapering proceeds. With that, fiscal policy. We got a 2-year budget deal. I mean, it's really a big deal. Congress finally, got a budget. Hadn't had a budget in almost a decade. Nice to have a budget. Makes good sense. Reasonable way to run a $10 trillion operation with a budget. And the good news about this, furthermore, is that it's a 2-year budget, so it gets us through to the next election. It removes a lot of the uncertainty that surrounded what the budget was going to be and whether the government was going to close down, which it did. I think we're past that now. And that's partly why the confidence numbers that I showed you, confidence charts, rose so strongly after the budget deal was made in December. And I think it is significant. It's about $1 trillion worth of spending. It removed the sequestration from the Defense Department, which was actually a very good thing because that was hurting the economy in Florida. We have a lot of big bases. So to get rid of that is very helpful, I think. But actual spending still goes down. Actual spending is going to go down by $44 billion. So it's going to go down less than it would have otherwise. It is less restraining, but it removes the uncertainty, which is what the biggest deal is. And I think Congress is going to raise the debt ceiling. I think there'll be a little bit of drama from some of the Tea Partiers, but I think the Congress has learned its lesson that it's very politically damaging and it's very expensive. I'm going to show you how expensive that brinksmanship in closing the government was in just a second. So I think Congress has learned that that's not in their interest. It's certainly not in our interest. So I think we get past that. I think, through the next election cycle, we'll begin to do something about our longer-term problems. Exactly what that'll be will depend upon how the 2015 election turns out. But I do think we'll begin to deal with those problems. I'm going to talk about that also in just one second. So here's the omnibus spending, and you can see on the right that spending levels go down under this bill. So there's still modest reductions in spending. This is total spending. This isn't the growth rate. This is the dollars. So spending has slowly begun to come under control in this country. Here is the cost of the brinksmanship. Look what happened to the 10-year and the 10-year bond rate and the 3-month rate during the budget battle. Not good. Not good. And furthermore, it cost a lot of money. We're talking $400 million from that drama. I don't think we can afford those soapbox dramas anymore. And I think, maybe it's sinking into a few people in Congress that, we're getting sick of it. So maybe we'll get not too much drama, we'll get past the debt ceiling, but I wanted to show you that this drama isn't free. It's very expensive in real dollar terms beyond the growth that it inhibits, that's more difficult to measure. This is just the cost of the rising interest rates during that period of time of the drama. Okay, so that said, I want to talk a little bit about the long-term fiscal policy, and I've shown you similar charts to this each year, but I just want to do it very, very quickly. This is the Congressional Budget Office chart. You can tell by the crappy colors because it's hard to see with the blue. But basically, up on the top in the light blue is the average amount of spending as a percentage of GDP. So since the early 70s through today, spending has averaged about 22% of gross domestic product. And the darker blue are revenues that have averaged about 18% of gross domestic product. That gap is the structural problem we face. It is not a business cycle problem because there's been ups and downs in the business cycle. It's not caused by Republicans or Democratic presidents or Congresses or any combination of them because we've had all combinations. There are 4 things that cause this structural problem, and until we address these 4 things, it doesn't get fixed. Social Security, Medicare, Medicaid, and defense. You could close down every other part of the federal government, every other part, and you don't fix this problem. Screwing around with, we can't extend unemployment compensation benefits because we have to pay for it is bull. It doesn't have anything to do with the problem. It has to do with the politics. It's not big enough. Yes, $1 billion is a lot of money, but not in the context of the federal government, not in the context of a $10 trillion economy. Social Security, Medicare, Medicaid, defense, that's what counts. When we deal with those, we'll deal with this problem. Defense is going to shrink. We already know that because we're going to stop fighting in Afghanistan and we're going to reduce that budget. So we still need to deal with the entitlements. We can't tax our way out of it because, as you can see, revenues rarely rise above 18% of GDP because when they do, people don't work as hard. No surprise. We cannot tax our way out of it. We can't spend our way out of it. We got to deal with it slowly in a considered fashion. If we go too fast, as they tried to do in Great Britain, remember, Great Britain said, oh, we're going to solve our problem because they had the same problem we did. So they squeezed down on the budget and they caused another recession. Revenues go down relative to GDP and they make the problem worse, not better. Remember, it's the amount of deficit relative to GDP that counts. So slow, considered, over time, we'll fix this problem. Social Security, Medicare, and defense. Nothing else matters. Just remember that. So going forward, here's interest rates. In red is the federal funds rate. Blue is the 10-year bond rate. Green are mortgages. You can see that very long zero amount on red, which is the federal funds rate. That is the only interest rate that the Federal Reserve directly controls. You'll notice to the right that the 10-year bond rate in blue began to move up before there's any movement up in the red, in the funds rate, because the bond market's going to trade ahead of the Fed, right? I mean, bond guys want to make money. I used to be on a bond desk. I wanted to make money. So how do you make money on the bond desk? You say to yourself, when's the Fed going to raise the funds rate? Oh, I think it may be July 2014. Okay, then I start selling the bonds in June. I'm going to sell before so I can try to make money. So the 10-year is going to anticipate and going to run 3 to 9 months ahead of the funds rate. But eventually, the Fed's going to raise the funds rate, starting probably in 2015. And it will raise the funds rate in 1.25 percentage point steps. And as it does, it's going to push the whole structure of interest rates up. It's going to push the 10-year up, and it's going to push mortgages up. So, as I said, in 2014, the economy is stronger than interest rates, because interest rates are starting from a very low place. By 2016, interest rates are getting up to significantly higher amounts. Now, even at the right, we're talking about a Fed's funds rate of 5 and a mortgage rate of 7.25. Not very high by historical standards, but it's still a huge increase in rates, 3 percentage points. That's enough to slow the economy, in my judgment. And here's what it might look like in terms of GDP. So good growth this year, good growth in 15, slower growth in 16. So the takeaway, my friends, is do all the business you can do this year. Be very aggressive. Begin to taper your own businesses like the Fed does and get ready for 17. Or as we say in developer world with the developer prayer that I love so much, Lord, give us one more boom, and this time we promise not to blow it. So make hay while you can and don't blow it, because interest rates are going to go up and the economy is going to slow down. But this is the year to really, really do it. The economy is really strong in Florida. Let's look at that now. So here's job growth in Florida. If you see on the right, you start to see the breakout. You start to see finally, the acceleration of job growth. I'm measuring this on a year-over-year basis to get rid of seasonality. So what you're seeing is on a year-over-year basis, we're starting to, now we're starting to get up, to 180, 190,000 jobs on a year-over-year basis. Finally, we're starting to see some strength, some real strength in Florida's economy. And I think it's very sustainable. This is employment growth by sectors. And so what you see is almost every sector in the green, which is the last month, so that's November over November 2012. You see almost every bar above the line except government. So the breadth of the employment growth is spread across all the sectors, which to me tells me it's likely to be more sustainable than if it's just one sector. You also see tremendous gains in education, healthcare, business and professional services, and trade. Population-related or tourist-related stuff is what's really driving Florida's economy at this point in time. And in fact, population growth is significantly stronger than the numbers are saying. We'll talk about that in just a second. But new claims for unemployment compensation in Florida, great leading indicator as it is for the nation. It's clearly pointing down, which means employment's clearly going to keep accelerating. And so I'm very optimistic about the way that looks. Here's the Tampa, St. Petersburg area, Bradenton, Sarasota also doing very well up at the top. Strong job creation in this part of the world. The whole West Coast has finally recovered, which is great. I mean, all the way to Naples. It's really good numbers. Here's population growth according to the census over the last 3 years for all the major states. Florida ranks third, as you know, in terms of total growth. What is interesting is census says there's been very little acceleration in the growth or change in the growth over the last 3 years for almost every single state. So pretty good rates of population growth, very little acceleration. This is a very odd configuration, especially for Florida. I'm very skeptical that this is the number, by the way, but we shall see. That said, population on a percentage basis, not only is Florida amongst the top 3, it's amongst the top 10 in terms of percentage growth. So very strong growth in our state, but again, according to census, very little acceleration in 2013. Here's another bunch of the census data, 11, 12. I don't have the 13 data yet, but what you're looking at is migration into the state. International in blue, legal, what we can measure, what we can count, the legal stuff. And in red, you see domestic migration. So census is telling us that domestic migration into Florida accelerated. International migration was at the same high level. Total population should have accelerated unless more people died. And I didn't remember any plague that killed a lot of people in Florida this year, so I'm suspecting that census doesn't really have the count right. And you can see it in your own businesses. We see it in the electric meters. We see it in all kinds of data. My point being, there's a lot more people moving into this state than census is measuring. Even census's own data is inconsistent with itself. So I really do believe things are significantly stronger. This is the annual population growth in Florida, the total bars. The total level is total population growth. So if you look on the left, you see that population growth in 2005 was over 400,000, right? And then you're seeing the growth by age groups. Now, as you scan from left to right, you see the recession, you see population growth slow down, right? You remember all the talk about the recession and high prices of housing in Florida and the hurricanes were going to drive all the retirees to North Carolina, correct? Remember that? And retirees here are in the green bars. Data doesn't lie, people do. The retirees didn't go away. In fact, when the prices came down for Florida housing, we got more retirees. What happened during the recession was we lost hundreds of thousands of jobs. We lost almost 1 million jobs in 3 years in Florida. And so what we lost was the younger age groups. People couldn't find work. They moved out of Florida. We actually lost population under 44 years old. So we lost working families and we lost their kids. And you also saw it in the school enrollment data. You know, all of a sudden school enrollments went down. Now what's happening is we're generating jobs. We're starting to attract back in the younger workforce. And you can see it in the data. You're beginning to see it now in the bars. And we're going to have a lot more of that going forward. So not only are we going to have strong growth, I believe, in retiree growth in Florida, we're also going to have very strong inflow of labor force age people and their children, school boards. There's going to be a lot more children than the models are suggesting to you, in my opinion. And there's going to be a lot more growth. And we're seeing it in the primary households who are purchasing housing in our state. So this is actually a very good trend for us, and I'm very optimistic, therefore, for next year. So that brings us to population growth in blue and employment in red. You can see a very strong cyclical upswing, slowing a bit in 2016 as interest rates rise, but nevertheless quite powerful. Not as strong as the huge boom on the left, but still, this is the time for Florida. I mean, we really got the wind at our backs now. And so this is going to be a really excellent period of time. By metropolitan area, if you look from left to right, you see the big spikes in blue in South Florida. Thank you, Hugo Chavez and Venezuela, as they screwed up their economy. And there's this massive, massive flow of Venezuelans bringing their money to South Florida. It's really extraordinary. But you see that slowing down as time progresses as you look to the right. And what you see is Tampa, Orlando, and Central Florida and the I-4 corridor beginning to take over, along with Southwest Florida. Very significant cyclical upswing across this area all the way down to Naples. Going to be a very strong year. You see something similar in the employment growth and again in housing. And of course, housing is going to move up strongly, and I'm very optimistic about what this looks like for not only our state, but for this area. So, housing starts will move up significantly, but not as much as you would expect given the population growth. We are still working off inventory from the last boom. There are still significant volume of foreclosures. There's significant amounts of REO properties owned by institutions that are slowly coming back on the marketplace. And it does have some effect. Here are the closings. These are the actual closings, not the starts. So in the dark blue bars are closings of existing homes. The red line is the prices for existing homes. So yes, existing home prices did increase in Florida at double-digit rates, in some markets as much as 25% in Miami-Dade County. Housing prices up 25%. People say, oh, that's great. Let me just remind you just quickly, without being too pedantic, about percentages. In Miami, just to pick a place, housing prices went down by 75%. They've now gone up 25%. Some people think if they go up another 50%, then we'll be back to even, except it doesn't work that way. If you had a price of a house at 100 and it went down by 50% for the sake of discussion, the price would be 50, right? If it goes up 50%, the price is 75, you ain't back to 100. Percentages. So, we got a long way to go on prices. We ain't going to get there this cycle. That's the bottom line. Yes, existing home prices in red will improve, but they'll improve at this point going forward slowly because there is inventory. We've kind of gotten out of the mode of the very distressed prices that allowed the prices to pop up. Now, if you will, most prices are trading at what is normal. But we'll have significant volume, as you can see in the blue bars on existing homes, till we get over to 2016. Same thing on the new, which tracks the starts. All right, and non-residential construction will increase significantly, especially retail and office serving, the population part that office serves. Because office includes things like veterinaries' offices and stuff like that that's really people-related rather than employment-related. And so I think we'll see significant improvement in non-residential construction, but again in the population-related areas. So let's transition and talk about Manatee County. According to the University of Florida official population numbers, population growth in the whole county slowed down a little bit in 2012 and 13. That's the official numbers. Hank Fishkind says that's not true. There's more growth than that. The official numbers are biased downward. And what's interesting about it is the growth that is projected by state and county by the university is lower than what census says. And as I showed you before, census can't even agree with itself as to how much growth there is. So I think there's more growth than what these data are indicating, but those are the official numbers that I share with you for what that's worth. Employment growth has been very strong in this area over the 12 months ending November 2013, 6,800 jobs. Significant green bars across every sector except finance. Even government was up in this area. So you got tremendous breadth of the employment growth. We have acceleration in most sectors. This is a really good-looking chart. When I look at this, I go, this is geeky me. This is a great chart because, it tells me this is going to continue. We're going to have continued strength, and you can see that again because new claims for unemployment compensation in Sarasota and Bradenton are clearly pointing down, which clearly means there's going to be more job growth over the next 6 to 12 months. A lot of momentum, a lot of good stuff happening. I think population growth in Manatee County is going to be significantly strong. Not quite to the past boom, but damn close. I mean, this is going to be really an excellent couple of years for this area. It's a very competitive place. It's a very attractive place. There's significant job growth. There's just wonderful housing opportunities and other things. So I'm really quite positive about what you have in front of you for the next 18 to 24 months. And then things will slow a little bit, but not bad. Housing starts will move up significantly, but again, you see the effect of rising interest rates kind of limiting the gains, but these are pretty strong. Nothing like, the excessive amounts of growth that occurred, back in the boom. And that's a good thing because these markets will basically stay in equilibrium as rising interest rates sort of slowly taper down the demand. Come on, baby. There we go. In terms of the existing home market, the big blue bars, red are the pricing. You can see the increase this year, unlikely to be sustained, probably 2 to 4% growth going forward here on existing home prices. New home prices a little stronger, but good levels of demand. I mean, very strong levels of demand in the existing and new home marketplaces. And I think there'll be a significant upswing in non-residential construction to be able to service this volume of population and employment growth that is on the horizon here. So I'm very positive for that. And I will end here and be happy to take a question or a comment, and we'd be happy to make sure you have copies of the slides for any purpose that you might see. Thank you so much for allowing me to come visit with you again this year.
You got one? Here we go. Wanted to please join me in thanking Dr. Fishkind again for coming out and being with us today. As those of you that have been to the event before noticed, we are in a new venue, and I want to thank all the folks at MTI for helping make this possible. I think they've been a very great host to us today. They were also instrumental in helping us secure a relocation for Air Products recently as well, with offering training programs that really helped make a huge difference in this area, being able to gain that business and that relocation. So I want to thank MTI for being the host today. And obviously want to thank each and every one of you, especially for taking the time out to, again, support the EDC and what it does this morning. Hopefully we'll be able to put all of this good news to work this coming year, and I wish all of you a very prosperous 2014 and look forward to working with you in any way we can. Thank you very much.